Welcome back. Right now we are seeing two different stories in the market. On one side, the companies in my portfolio are doing incredibly well. On the other, the news is full of worries about tariff and potential economic slowdown. This report will break down why I believe in the strength of my companies and why I'm sticking with my strategy despite the headlines. I will look at the hard data to show that the long-term picture for my key holdings remain bright, and the decision to continue investing in my top picks, Alphabet and Amazon, is the strategic one. Based on their future potential, the recent quarterly earnings report showed a clear and compelling strength from my core holdings. From technology to commerce, my companies have proven their business model are resilient and well-positioned for the future growth. Let's look at the chart and some of the key comments from my holding companies' earnings call. If we look at the chart right here, this is Alphabet. Revenue came in at $96.43 billion, increased 13%, positive 13% year over year. And EPS was $2.31 to $2.31 and increased positive 22% year over year. And next day, stock doesn't really did anything because the capex outlook rised by $10 billion to $75 to $85 billion. Initially, it was $75 billion, and now for outlook for 2025 is $85 billion. Move on to Amazon. Revenue came in at $167.7 billion, increased 13% year over year, and EPS came in at $1.68, increased 33% year over year. And next day, stock crashed. Negative 8% is not actually crashed. And due to Q3 operating income guidance, midpoint implies only 3% year over year growth. And Meta crushed it. $47.52 billion, increased 22% year over year. And $7.14 was the EPS, also increased 38% year over year. And Meta next day was mind-blowing, expected. And the key comments from Mark Zuckerberg was capex growth. Not really mentioned what could be the total dollar amount, but it is going to be increased. And Uber revenue came in $12.65 billion, positive 18% year over year. And EPS was 63 cents. Doesn't really grow here, 0.63% year over year. And Uber announced $20 billion share repurchase, which means the company is really confident in the cash generated coming in the business. Okay, move on to, I kind of forgot ASML. This is one of the hard if we compare the chip industry. ASML is the heart of the chip. So maybe one day I'll make one video for ASML. This is the crucial company. Lately, investor kind of forgot about this company. So it's only going downward trend. Revenue came in 7.7 euros. This is a Dutch company, and which is combination of $8.95 billion if you count in dollars. Also increased 23% year over year. EPS was 5.90 cents, 5.90 euro, and $6.86. Increased 12% year over year. The 12% year over year is not a bad one. But next day, stock negative 10% in the day. So it's actually the CEO mentioned cannot confirm growth for 2026 due to macro and geopolitical uncertainty. It makes sense. Recently, the tariff situation actually makes sense, but this company will recover, come back. I think this year, this company, maybe if not this year, next year, gonna be $1,000 per share. Next, we have MasterCard and Visa. So revenue came in at $8.13 and 17% increase year over year. $4.15 per share and 3% growth year over year. Visa also $10.2 billion and EPS was 14% increase year over year. So if I look at my portfolios, right, all the company have their revenue double-digit growth, 13%, Meta 22%, Uber 18%, Amazon ASML 23%, which means there is no company in my portfolio growing at single digit, and their EPS growth, look at the growth rate, 22%, 33%, 38% Meta. This is the Uber. Actually, they didn't have much EPS growth, but their cash in the business coming actually greater than the EPS growth actually. Move on to another topic. To make a smart decision, we need to look at the past scary headlines and understand the real economic debates. The truth about tariff, there is a lot of debate about tariff. Here are two sides. One hand, tariff is tax on imported goods, which can lead to higher price for consumer and businesses as well, potentially slowing down the economy. Makes sense. We are already seeing some of this in the US inflation ticking up lately. On the other hand, tariffs bring a lot of money for the government. The US has collected $152 billion so far this year, which can help reduce national deficit. So tariff have both a cost and benefits. What really drives the economy actually? Many believe that if the consumer spending slows, the economy will go into a recession. Since consumer makes up 2/3 of the economy. However, history shows this isn't quite right. Looking back at every recession since the 1960s, the real cause of the downturn wasn't consumer spending less, but businesses stopping their investment in things like new factories and equipment. Right now, businesses' investment is very strong, outperforming all expectation. This suggests the economy can handle a slowdown in consumer spending without falling into a recession because companies are still confidently investing in growth. Analysis and news headlines are often pessimistic, but they are frequently wrong. The best example in the COVID-19 crash in early 2020. The market fell about 35% in just over a month, and fear was everywhere. Most experts predicted long and deep recession back then, but they were wrong. A massive response from the government and the Federal Reserve, combined with the strength of technology companies, lead to one of the fastest recoveries ever. The market started bouncing back just weeks later. This is a powerful lesson. Uncertainty creates opportunity. And the worst time to sell is often when fear is at its highest. Despite all the concerns, I'm actually adding my position in Alphabet and Amazon. Here is why. Alphabet, the stock is cheap compared to its peers, trading at the lower valuation than the overall market. Its Alphabet core search business is still growing strong, and its new AI features are very popular. Plus, Alphabet cloud business is growing faster and becoming very profitable. It's a great way to invest in AI future for a reasonable price. Second, Amazon. Amazon is the clear leader in cloud computing with AWS. Market has a huge runway for growth. The stock recently dropped because the company is investing heavily in AI for the long term, which temporarily lower short-term profits forecast. I see this as a buying opportunity. Amazon has done this before, and it has always paid off for long-term investors. On top of that, Amazon advertising business is boom, the path to doubling in the next decade. I believe both stock can be double in the value over the next decade. To double in the next decade, the stock only need to double in the next decade. The stock only need to grow as an average 7.2% per year. I expect both Alphabet and Amazon to grow their profit as much faster than this, in the high tens of faster, even faster than high tens of percent. This strong growth gives us a large margin of safety. It means that even their valuation don't expand, the stock price will be still perform very well, driven by fundamental earning growth. Take a look at this chart. Illustrative 10-year growth scenario for Alphabet and Amazon. Okay, first thing, Alphabet. Current market valuation is $2.4 trillion. If Alphabet grows low 90s, 9%, and 18 times PE ratio, right, it would be $4.52 trillion in the next decade, which is relatively low because nobody wants 9% return in the decade. Okay. And in the medium term, if Alphabet grows at 12%, which is currently Alphabet growing, and 18 times PE ratio, which would be $5.96 trillion, which is 9.5%, 148% overall after the decade. But 9.5% is still, if I really want 9.5%, I just simply invest in the S&P 500. And the higher 15% growth and 18 PE ratio, that would be $7.77 trillion, which is 12.4%, 224% in the next decade. So overall, I believe that either medium scenario or the higher scenario will be occurred in the next decade for Alphabet. Amazon, the lowest is 15%, which is Amazon basic growth rate, and PE ratio, if 2.2 PE ratio 22x, that will be $7.96 trillion, 12.7% return after the decade, which could be 232% at the end of the decade. So it's still like reasonable, but I believe Amazon could reach 18% growth rate and 22 PE ratio. Amazon basically stay in higher PE ratio because of the growth. And that will be $9.94 trillion, 15% year-over-year return, and there will be 314% return. It sounds like crazy because 5 trillion, or like if we talk about 12 trillion and $9 trillion. Think about it. In the back early 2000, nobody even could think about $1 trillion valuation, right? Nobody even could imagine $1 trillion valuation. Ultimately, we reached trillion valuation. Now, very easily, NVIDIA reached $4 trillion, even higher, the NVIDIA is still growing. Microsoft, the valuation is $4 trillion, still growing. So now, if we imagine $9 trillion, right, it could feels like flying over the head. But if you look at all these companies' growth rate, at some point in the next, maybe in 5 years or 6 years, right, $9 trillion would imagine people when feel about the $9 trillion, they will think that still is kind of small valuation. Because as time goes by and people mindset and market valuation, everything change. Move on. In short, my key companies are performing exceptionally well and investing smartly for the future. The economic fears you heard about in the news are either overblown or based on the incomplete picture. History shows that corporate investment is a better indicator of economic health than consumer spending. And that business investment is currently very strong. Therefore, I'm not really concerned about tariff. Please don't take my word. I'm just a random guy in the YouTube. Do your own due diligence before you're making investment in the market, because this market has no sense. You cannot ask for logic, because this market has no sense. So it could be anything tomorrow. That's all for today, and I'll see you in the next one.